the discipline. This is our last meeting, at least in theory. If you need additional meetings, we can meet afterwards, but for now, we have to finish the curricula. Have you managed to advance with your financial forecastings?
I at least for myself, I stopped at the marketing plan. I didn't do the forecast. I have a question for the meeting last week for 16 of April. Was it recorded? Because I cannot see the recording on the platform.
Yes, that's a good question. Yes, we did record it. It is true, I did not manage to upload it yet, but I will. I will
Okay,
this
okay.
evening, I promise you. I don't remember, you didn't attend last week?
Last week I couldn't attend, no. And yeah, I still have to do so. I stopped, at least for myself. Probably my colleagues are more advanced. So I stopped at the market planning. So I did the market study, a survey as you suggested. It will be okay. And then I
Yes.
stopped there. So I still have to do point 5 and 6.
Okay, no worries. Yes, you need to forecast the revenues and the charges. What we did last week was to finish the operating budget, and then from the operating budget, we got to the cash flow statement. Well, the cash flow statement from the operating activity. And today, basically, we get to the most technical part of everything that we are doing, and maybe we should get into it.
Okay.
I'm sharing my screen in a moment. Okay, so you should be able to see my screen. On it, you can see, at least for my simulation, the cash flow statement. I imagine that most of you did not get this far, but it's okay. You did not have for today the deadline for submitting this part. You still have time. Uh,
I
I'm
have a
sure.
question. So for this operating budget, I guess all of them are more or less estimations. So it has to be somehow a realistic estimation, something like that. Yes.
Yes, of course.
Okay.
So what we are trying to do is not to guess what is going to happen in the future. So it's not a simple guess. It's a planning. We are planning our own activity, but of course, this planning will be based on probably tens, if not hundreds of factors that we cannot control 100%. In our financial forecasting, we tried to color these factors in green, at least in my case. Everything that you can see here colored in green shows different factors that are not entirely under our control. So yes, this is our financial planning, but for sure we don't pretend like these are certain values. We are aware of the fact that all these green cells contain hypotheses about different factors that are not under complete control and that will change. For sure, we will have variations in the future, which will mean that the result of this simulation, which is for us this net operating cash flow, will not remain the same. Now, I have to come back to the structure of our feasibility study. Where we are is here. We finished the fourth chapter, uh,
And
and
for the
today,
fourth chapter, for the product and so on, I for the third chapter, sorry, uh, do we have to write? So I did the market analysis, and we have also have to mention the main competitors, description of the product and so on, right?
yes, I imagine that for the market analysis, as you said, you did the survey. I imagine that you processed the data. Maybe you have some charts.
Yeah.
Copy the charts here, explain the conclusions. Then, yes, continue with the main competitors. For the main competitors, I don't know, four, five. whatever it may be the number, try uh, to find relevant information concerning their marketing strategy. So obviously we would not be interested in their rich history, their beautiful work. So none of that. We are interested in their list of products, maybe the main characteristics of their products, the prices, so their price policies, their promotion policy and placement policy. Why? Because for the last part of this chapter, we need to develop our own market strategy, our own marketing mix. And we are developing our marketing mix having in mind a certain objective concerning the demand. We are trying to attract a certain demand from the market. And for that, on one hand, we need to understand the market, which is why we did the survey and the analysis in general. And on the other hand, we need to understand the marketing strategies of competitors. So we would develop our own strategy, again, in the limits, in the framework determined by the market analysis and by the strategies of the other competitors. And our own market strategy is targeted on what? On generating for us the demand that we are setting as an objective. Then, based on this objective in terms of demand from the market, we can do the financial forecasting. We can forecast the revenues based on maybe on one hand our production capacities and on the other hand based on the demand that we hope to attract. Then, starting from the forecasted revenues, we can plan for the charges. The charges representing the value, the monetary value of the resource consumptions that we need to register in order to sustain the revenues that we are targeting. So there is a link in such a manner between all these components of the study. And in the end, you should get to this forecasted cash flow statement, from which we are mostly interested in the last line, the net operating cash flow. And I'm coming back to the structure of our feasibility study. Today we are going to analyze the financial feasibility of our investments. But to do this, we compare two elements. On one hand, the value of the capital that we need to invest according to our investment budget. On the other hand, the financial results, effects of operating this investment seen through this net operating cash flow. So we are comparing basically the value of the investment to the yearly values of the net operating cash flows. In the end, we try to see whether we would be able to recover our capital, the invested capital, through these future, well, hopefully forecasted in any case, operating cash flows. And of course, this is not the only objective, just to recover the capital, but also to generate a minimum amount of financial gains.
I also have one more question. So, will this the example of the forecasted revenue and so on, the Excel, will it also be uploaded on the platform to utilize the formulas and everything?
Yes, of course, but you have access to it. This Google Sheet that I'm using is already there. Let me.
Oh, it's in the forecast simulation. Oh, I found it. Sorry.
You found it. Okay.
Okay, sorry.
Of course, it's there, and you have access to it. Of course, that was from the beginning my suggestion. Start from it and just try to adapt the tables to your own business. So you
Okay,
can,
thank you very much.
and I can upload some more, and I can upload another maybe 2 or 3 examples, maybe a bit different.
That will be useful, at least for me. If you have, for example, an example in the area of services, not necessarily products, it will be useful for me because my project is around services being sold.
I understand. If I don't have examples of services in English, for sure I have many of them in Romanian. So
Any
In the
language
worst
is
case
good.
scenario, I'm going to upload one in Romanian. For sure, I have hundreds of them, but most of them are in Romanian.
Thank you. Thank you very much.
No problem, of course. Also, don't forget that you have uh, a guide, a textbook, where you also have an example. You can find it, it's true, it's also in Romanian. You can find it here, the cost benefit analysis guide. So
Okay.
it's a PDF guide which explains and also shows uh, with tables an example which is, I believe, in services. It's true, it's about medical services, but services nevertheless.
Okay. Thank you.
Don't worry, you will have examples. I'm sure that this is not going to be a problem. Okay, coming back to the structure of my feasibility study. So today we are comparing, as I was saying, on one hand, the value of the investment to, on the other hand, the value of the yearly, of course, forecasted net operating cash flows. So this is what we work towards. In the maybe second or third week, we got to configure the budget. Now we also have the net operating, then the forecasted cash flow statement, and now we can compare the two to see whether the investment is feasible, at least from the financial point of view. In order to do that, by comparing these two components, we are going to construct several indicators, several ratios. Some of them you might know. I mean, some of you for sure you might know them. I'm sure that at least some of you already use the net present value or the internal rate of return. But apart from that, there are also some additional indicators such as the cost to benefit ratio or the uh, payback period, the time in which we can hope to recover our capital. So there are several financial indicators. Okay, uh, before we do that, I need to talk to you about the value of money in time. Uh, some of you probably know what this is about, but for those that don't, why is it that 100 euros today is more than 100 euros in 1 year from now? Can anyone tell me that? Let's say that I'm asking you to lend me 100 euros today, and I will pay it back to you in 1 year, in 2025. In 2025, in April, I'm paying you back 100 euros. But in doing so, you are really at a loss. Why is that? Because I'm giving you the 100 euros back, but you lose nevertheless. What is it that you lose?
because the money lose his value with the time.
Yes, Saul, we are talking about the value of money in time, but can you be more specific? Why is it that you are losing something in time?
It's because of depreciation of.
When you say depreciation, are you thinking about inflation?
Not necessarily. The loss of inflation is one, I think, one aspect, and then you have what the assets they lose value in time, and so
Yes, but
on.
there are no assets here. You're giving me money. You are giving me 100 euros and I'm giving it back to you in 1 year.
I think it's the maybe missed opportunity because maybe with that money you can do something else.
That's exactly right. So listen, if we would be talking about normal conditions, we would probably also have inflation. So maybe if you give me 100 euros today, and with 100 euros, I would be able to buy 100 kilos of bananas. Maybe the price for a kilo of bananas is what, 6, 7 lei. Let's say it's 5 lei. And I can buy 100 kilos of bananas with those 100 euros. In 1 year, indeed, if there is inflation, let's say of, I don't know, 10%, 5%, when I'm giving you your money back, those 100 euros, you should be able to buy less, maybe 95 kilos of bananas. So you would be losing 5 kilos of bananas because of inflation. But that is not what I'm talking about, because in any case, in our forecasting, we did not take inflation into consideration. And this was not just to simplify things. This is how it's usually being done in real practice most of the time. So we are not talking about inflation. We are talking about exactly what you said, the loss of opportunities. Let's say that you have those 100 euros today, and you have the possibility of creating a bank deposit. I'm sure that you also have other opportunities, but let's take this one because it's maybe simpler and more obvious. You can create a bank deposit, and in 1 year, if the interest rate should be of, I will say 7%, it's 7% in lei. It's not 7% in euro on one hand, and on the other hand, it is 7% in lei under inflation conditions. So if there would be no inflation, for sure it would be less. But let's ignore that for the time being. Let's say that it's 7% the interest rate. So in 1 year, you would be able to get your money back from the bank, and you have some 7 euros, additional 7 euros. So you would have 107 euros. If you lend the money to me and I'm only paying you back 100 euros, you would at least lose those 7 euros. The interest rate, or rather the interest that you would have been able to gain in this case, the other opportunity. Of course, you may have other opportunities. You may be able to invest in shares from different companies, or maybe in bonds from the Ministry of Finance, or who knows, different stuff. So it is about these missed opportunities. There may be 10, 20, 30 opportunities that you would be thinking about. Of course, it would be only normal to take as a benchmark, to take into consideration the most fruitful opportunity. Let's say that this opportunity would give you 10%. So you would have 110 euros in 1 year. If I were to pay you less than that, you would be losing something. Now, I want to put the question the other way around. If I were to promise to give you 110 euros in 1 year from today, how much would you be willing to pay today to gain 110 euros in 1 year? You should be able to do a computation the other way around. If you would be expecting 10% for your investment, and the value in 1 year would be of 110, you'd probably be paying 100 euros today. Do you get my point? We are trying to see, because we are in the position now of more or less knowing the financial outputs, the financial results of operating our investment. I am talking about these net operating cash flows that you can see right here in my Google Sheet. These, of course, in our estimation, will be the future financial results of operating this investment. So basically, us thinking about doing the investment at the present time, this is what we would be able to gain. This is what we hope to gain in the future, these net operating cash flows. So now the question is, what would be the correct price of these future gains. Because the price that we are paying is the value of the investment. But let's ignore that for a moment. Let's say that someone promises to give you these values in the future and asks you for a price today, to pay something for them today. How much would you pay today for these future gains? It's exactly what I asked you a minute ago. If you were to be given 110 euros in 1 year, how much would you pay today to have that 110 euros in 1 year? If the rate of return that you would be expecting is 10%, you would pay 100 today. So the price today would be of 100 that you would be willing to pay for something that would give you 110 in 1 year. Do you understand where I'm trying to get?
For me, yes.
Okay, so the others, it would be great if you would ask me questions if everything is not clear. Again, the point is we have an infrastructure in front of us that promises to generate these gains in the future. And we don't know whether it is a good idea from the financial point of view to pay for this infrastructure, whatever we have estimated in our investment budget, because that's the price. That's the price that we would pay for the infrastructure. An infrastructure, that would hopefully bring us these gains in the future. And I have to decide whether the price of this infrastructure, the value of our investment, is fair. So I'm ignoring the value of the investment budget for a moment, and I'm trying to evaluate, to estimate the present value of these future gains. I'm ignoring the investment for the time being. Someone promises me these future gains, and I'm in the position of thinking, okay, what would be the price that I would be willing to pay today for these future gains? Again, if these future gains will be, let me make it simpler, and I'm going to make an additional simulation here. Let's say year 1 to 5. Oh, that was not what I meant to do. This could be whatever, 2025, 2026, and so on. Let's say that someone promises me 110,000 in 1 year. What would be the price that I would pay today, or what would be the sum that I would be willing to put forward today to have 110,000 in 1 year? Well, it all depends on the return that would satisfy me. Let's say that I would be satisfied with a return on my investment of 10% per year. Then I would be investing today no more than, let's see, the future value of 110,000 over 1 plus 0.1 or plus 10%, 100,000. If I were to put forward 100,000 today, and I would be getting back 110,000 in 1 year, that would mean that I would be getting back my 100,000, my invested capital, plus an additional 10,000, 10%. Exactly the return that, as I was saying, would satisfy me. If I would be only satisfied with 15% for the same amount, 110,000 in 1 year, I would be willing to pay today no more than, as you can see here, 95,652. Just 1 second. Hopefully you understand this perspective. If I'm expecting 20% for 110,000 in 1 year, I would be paying today 91,000. And you can see that with the increase of my expectations in terms of return, the value that I would invest today lowers. If I expect 50%, I would invest 73,000 today to get 110 in 1 year. You see? On the other hand, if I'm satisfied with 5%, I would pay almost 105,000 today for 110 in 1 year. Okay? So, what is the position that we are in right now? Someone promises us these future gains. I have them here. So now the question is, let's say that we do expect, let's say 15%. How much would you pay today, year zero, although it's not really year zero, but let's say that it is for the time being. How much would you pay today? I can enlarge the picture a bit. How much would you pay today for these 47,000 in 1 year, in 2025 or 2027? Let's say for now, 2025. Well,
You apply the same formula.
of course, the same formula. I would pay 47,000 over 1 plus 15%. Okay, but that is not all that I am promised. I am promised that in the second year, I would also be paid 93,000. So how much would I pay today for these 93,000? Well, I would pay 93,000 over 1 plus 15% square at the power of 2. It's in 2 years. I would pay 70,000. How much would I pay for this value at the end of the third year? I would pay 118 over 1 plus 15% at the power of 3. Fourth year, the same thing. At the power of 4. And finally, for the fifth year, this over 1 plus the return rate, the expected return rate at the power of 5. So again, someone promises to pay me these values over this time, this 5-year period. How much would I pay today to get these values in the future? Well, this is how much I would pay. The sum of all this. So
And
in
basically,
order
in the concept of someone promised me, it's actually our forecast of revenue. So what we expect to get as revenue.
exactly right. This is what we are going to try to do, to estimate the present value, the present price, if you will, of those future gains. We are getting there. But for now, I just want to make sure that everyone understands. If I simply do the sum of these 5 future values, you can see it's some 520,000. But would I be willing to pay 550,000 today just to get it back over this 5-year time period? Obviously not. It would be silly. So if I take them by turn, as I was saying, to get 47,000 in 1 year, I would pay today 40,879. If I were to do so in 1 year, I would be getting my money back, the 40,879, plus a return of, well, the difference between the two, which should be 15%, 6,000 over. There you go. You can see? So someone promises me 47,011 in 1 year. I would pay for it today 40,879, and in 1 year, by getting paid 47,011, I would be getting my money back, the 40,879, plus an additional 6,132, which is 15% of my investment. So if you promise to give me 47,000 in 1 year, how much would I pay you today to give me that in 1 year? And I'm thinking that I want a return on my investment of 15%. I would do this calculus, and I would offer you 40,879 today. And that way, when you pay me back, I would get my capital back plus a return of 15%. I did the same for the other future values, future gains. So as you can see, what we are doing is evaluating, estimating the price that someone would be willing to pay today for these future values. How much are they worth today for someone? For someone that expects 15% for its investment. So we have the future values. We will establish this rate of return that we are expecting. For now, I said 15%. It could be more, it could be less. And based on these two parameters, we can establish what is the price that we would be willing to pay today for these future values. I hope that everyone understands the logics of it. Why are we trying to do this? On one hand, we have these forecasts. On the other hand, in order to get them in the future, we came to the conclusion within our feasibility study that we need to do an investment of whatever it may be, let's say 300,000 euros. The investment that resulted from our investment budget. And we are wondering whether it is worth it, whether if it's a good idea from the financial point of view of investing 300,000 in this infrastructure. Of course, in my case, made up of land, buildings, equipment, and so on. Should I pay 300,000 for this infrastructure? I'm not really paying 300,000 for the infrastructure. It's not the infrastructure that I'm really buying from the financial point of view. What I am buying is the promise for these future gains. I'm doing the investment not to own an infrastructure. I'm doing the investment to own those future gains. So the simple question is the price of those future gains worth the value that I'm paying? Is the price for those future gains equivalent to the price that I would be paying by doing the investment? Is as if you would go to the market. I'm sorry. And you are decided upon paying, I don't know, 5 lei for a kilo of apples. You get to the market and the price for the apple is lower, of only 4 lei, lower than you would have been willing to pay. Obviously, you pay the price. If the price is higher, then you are willing to pay, you will not pay the price. Think of it in the same manner. You have these future gains, expected gains, forecasted gains, which are really what the investment would offer. Now, the question is, how much would you be willing to pay for them? To determine that, you do this, what we did here. And you establish that you would pay 335,000. This is how much they are worth to you. 335,000. These future gains. And now you look at your investment budget. Let's say that it is of 300,000. That means that you can buy these future gains that are worth to you 355 today. You can buy them today for 300,000, which would mean that there is the investment would have a positive net present value. The difference between the value of these future gains, between the present value of the future gains and the present value of the investment. The difference between the value of the apples, 5 lei for you, and the real value of the apples in the market, 4 lei. There is a net present value of 1. You gain, from this perspective, 1 monetary unit. Okay, I will leave it here for the time being. I will come back to the subject and hopefully you will understand it even better. I'm going towards the return rate. I said here 15%. How do we establish it? Because as you have seen, this rate of return changes a lot. The present value of these future gains changes a lot based on the rate of return. So why 15% and not 20, or why not 10? Now, you have to take into consideration the rate of return available to you in other opportunities of investment. There are several ways of establishing this expected rate of return. Give me 1 second. This expected rate of return, which is being called in this context discount rate. We are discounting the future gains, which is why it is being called discount rate. I was saying that there are several ways of estimating, of establishing, because this is what we are really doing. We are deciding upon a specific discount rate. One way of approaching things would be based on the cost of the capital. In our case, as we are analyzing an investment, of course, we already have the investment budget. We have already established the financing sources, and we should know the specific financing cost for each source. As, for instance, for the bank loans, we know the interest rate and the administration fees. For the lease contract, we know the interest rates. For the equity, we normally should be able to know or establish the dividend rate that the shareholders would be expecting. So my point is that we should be able to know the average cost of the capital. Let's say that the average cost of capital would be of 12%. The yearly cost, I mean, of course, 12%. So in this approach, they usually in real life, in practice, they usually use the average cost of the capital as a discount rate, figuring that the investment should at least generate a return equal to the cost of the capital. This way, the net operating results from the investment would be enough to allow for the capital to be recovered and in addition to pay the cost of the capital. You see? So this is one approach. A different approach for establishing the discount rate would be to start from the rate of return for investments with no risk. This is not the case for us. What are the risks that affect our equation? There are at least two types of risks. Because as you have seen, we will be comparing on one hand the value of the investment and on the other hand, the value of the future net operating cash flows. Both of them are subject to possible risks. And where do these risks come from? Well, honestly, they come from all the green cells from our Google Sheet. As you recall, everything that we entered from the keyboard, we colored in green. At least I did in my simulation. Because all these values that I inputted from my keyboard were hypotheses concerning the values of different factors that we don't have 100% under our control. So this means that all those values from the green cells could be changing in the future over the forecasting period. And to tell you the truth, for many of them, it's not that they could be changing. It's almost certain that they will change in time. I mean, it would be, again, silly to expect, for instance, for the price of electricity to remain exactly the same for the entire 5-year period of forecasting. Not to say that it's not only really 5 years, because as you know, there are also the 2 years of implementation. So I would really say for sure the price for electricity would change in time. And this would happen for many of the other factors. It's almost certain that they will fluctuate in time. We don't know when, we don't know how much, but such changes will occur or would probably occur. Of course, if the price for electricity, for instance, increases, this is a risk that will determine a decrease of our net operating cash flows, and the other way around. So my point is that the forecasted net operating cash flows are subjected to a lot of risks. Of course, some more important than others. And you will see that in the final part of our meeting of today. We will do simulations. But the truth is that the value of the capital to be invested is also subjected to risk. We have our investment budget, but if we decide to do the investment, it will take us, at least in our planning, it will take us 2 years to implement the investment. During these 2 years, the prices for the investment components could change. Additional, maybe charges could appear. And this happens. This happens, I don't know whether to say many times, but for sure it happens. There are risks. So again, my point is that our forecasting is far from certain. It is affected by risk, but it could go both ways. The situation might change, and who knows, we could even gain more than we forecasted. That is also possible. But coming back to the second way of establishing the discount rate, we look at a possibility of investing capital which involves no risk. Usually, all over the world, the type of investment that is considered to involve no risks is the buying of public bonds, right? Obligațiuni. So usually the thinking is that when you buy public bonds, you are certain to get your capital back plus the promised interest rate. So the risks are usually considered non-existent. This is the basis then in this analysis. And now you compare this situation to our own, to our investment. And you try to take into consideration as well as you can, obviously, all those risks that our investment involves during the implementation period and maybe mostly during the operating period. Now, considering these risks, let's say that the rate of return for investments in public bonds would be of close now in lei in Romania it is probably close to 7%, but again this is under inflation conditions. Let's say that it's whatever 3%. So if you are able to invest capital with no risk, with a yearly rate of return of 3%, how much more would you expecting in terms of rate of return to be convinced of investing in this field, in this objective, with all these risks, by considering the additional risks involved by our investment? And you estimate maybe an additional rate margin of, who knows, 5%, 10%. A margin of return which in your mind at least would cover the extra risks. So if the base rate was of 3%, your margin to cover the risks is established by you, of course, at 10%, you would be demanding 13%. To decide not to invest your capital into public bonds for 3%, but to invest your capital in this investment objective, whatever it may be. Okay, so this is the second approach. Of course, the part with the base rate, the rate of return for the public bonds should be easy enough to establish. The other part, the margin, would be more difficult because it's easy to say, okay, what's the margin that would satisfy you to take these chances, these risks? But how can you answer to that? In theory, you could say, well, let's try to quantify these risks. But by definition, these are risks. These are not certain facts. There's a probability. And let's face it, we would never be able to accurately estimate the probability of those risks materializing. So it is an approach, a valid approach, but we will always have to approximate the margin. What we can do is to try to understand the most important risk factors. So we would get a general view of the risks, and then to decide upon the margin that we would be expecting to take these risks, we could try to look at investments done in maybe other companies by other people if we have access to such information, or maybe if we have other opportunities to compare this with those other opportunities and to see and to compare on one hand the risks and on the other hand the expected, the forecasted returns. So hopefully by comparing our investment with its level of risks to other investments with specific level of risk, ideally finding investments with similar level of risks. If, let's say, another investment with a similar level of risk would promise us maybe 15%, we would probably not do this investment for less than 50% because we can get 15% in the other investment. So again, this would be a second approach. Just to make it clear, here we would have a base rate and a margin for the risk. The third approach would be much similar to this second one by just comparing directly the different investments. And if we should have maybe 3, 4, 5, 10 other opportunities with similar levels of risk, we would set as a discount ratio for the analysis of this investment the rate of return for the best of the other investment opportunities. So my point is that there are different ways of establishing the discount rate, but in the end, it's ours. It's us being the people that would decide to do the investment or not. It's us that would establish the discount rate. We can do it try to do it in a scientific manner through one of these approaches, or we could just say 10%, 15%, 20%. It's up to us in the end. Now, having said that, let's say that we do establish the discount rate at 15%. I imagine that we could all use 15%, not to make things complicated. If you all agree, I suggest we all use simply 15%. And we would consider that it was established through one of these methods. So let's say that we do use 15% as a discount rate. Now we have everything we need. So I'm sharing my screen again. And I'm coming back to my Google Sheet. Hopefully you can see it. I'm going to delete everything that I have here. And I'm going to start from scratch. I'm going to create a table that you should be able to use later on. Let's say a description. For the time period, I believe that most of you, if not all of you, you have taken into consideration implementation periods of 2 years. So I'm going to make the simulation for 2 years of implementation. You can adjust it if you need to. So I'm going to say I1 from implementation, year 1 of implementation, year 2 of implementation. And after that, year 1, 2, 3, 4, 5, these are the first 5 years of operating the investment. Now, in my case, the value of my investment was of I think I have it here. Budget simulation. The value of my investment in the end went up to 508,000 euros. I did the simulation for 24 months. That's great. So I'm coming back here and I'm writing on the first line the value of the investment. But remember that we are in year 0. So before these 2 years of implementation. So the value of the investment for these 2 years would be of, let's see how much. Investment 1 for the first year, investment for the second year. For the first year it's 220,000, and for the second year, the rest of it, of course. And I get to a total of 508, so it's correct. Now, I'm taking these 2 values in my simulation here. First year and second year. Now I'm going to take here the value of the net operating cash flows. Let's say forecasted net operating cash flows. And I'm getting them from the cash flow statement. Okay. And now we have both of them in front of us. So this is what I hope to gain. This is what I am to pay for these future gains. I am to pay 508,000 euros for total future gains of 520,000. But don't forget one thing. We talked about it 2 weeks ago. We did the financial forecast only for the first 5 years of operations. But we are aware, we understand the fact that the investment, the infrastructure that we are creating for the investment would still be able to generate financial gains even after this 5-year time period. And we have said that the value of those future gains, we are going to try to estimate it in a much simpler manner under the form of a residual value. So I wrote here residual value, the value of the gains, the future gains that this infrastructure could generate after year 5. We estimate this residual value at the end of year 5. We will come back to see how we can estimate it. Let's say for the time being, 100,000. I will come back to this. So now we have the investment, the value of the investment. It would take us 2 years to implement it. After that, we would be starting the operating activity. During the first 5 years, we expect these net operating cash flows. But after year 5, we expect the net operating cash flows to continue to be positive for us at least a certain period of time. And the value that we expect that someone would pay, the market value of those future gains from after year 5, estimated at the end of year 5. For now, I'm saying that it is 100,000 euros. Again, I will come back and we will discuss different possibilities, different methods of estimating it. But again, this is what we would gain the sum of these two types of values. And this is what we should pay for these future gains. Is it a fair price? To establish that, we need to estimate the fair price for these future gains and then compare the fair price to the price that we are being asked to pay based on the investment budget. So this is what we are doing. I need to introduce here the discount rate. And if you agree, my proposition is that it would be 15% for all of us to make things simpler. So I'm marking it in green. Now, we have to bring everything at the present time. This means that we are going to discount even the values from the implementation period. Let's say now discounted net operating cash flows. These would be the net operating cash flows from which we deduct the return of 15%. What's left is the price that we would pay for them today. So it's the nominal value of the yearly net operating cash flow. Just 1 second to change the keyboard. Over 1 plus the rate of return, the discount rate, at the power of, in this case, 3. It would be this net cash flow would appear 3 years from today, in 3 years' time. In the same manner, I'm estimating the discounted net operating cash flows for the following years. For year 5, for instance, the nominal value over 1 plus 15% at the power of 7 in this case. What are these? As I tried to explain it to you before, these would be the prices that we would be willing to pay today for these future values. These would be the prices that would allow us to get our money back and to get a yearly extra 15%. Let's do the same for the residual value. Discounted residual value. The residual value over 1 plus the discount rate at the power of 7. So let's say now present value or discounted value, present value of all future gains, forecasted gains of all future gains. So it's the sum of all this. So this 286,645 would be the price that someone would pay today for these future values if that someone would be satisfied with a 15% rate of return, 15% discount rate. Okay? So we estimated the value of all the future gains. Now we need to compare this value with the present value of the investment. I'm doing the same thing for the investment payments. And now, as a difference between the present value of the future gains and the present value of the investment, we calculate the net present value. If you wish, as a difference between the price that we were willing to pay for the kilo of apples, 5 lei, and the price of the apples in the market, 4 lei. Hopefully the difference is positive. In our case, obviously it isn't. So net present value of the investment, of course. Is the present value of the future gains less the present value of the investment. Let's use the sum function. Make it more general. In my case, at least for now, it's a negative value. What does that mean? That for me, the value of the future gains is of 286,000. But to get the property right for those future gains, I need to pay today 409,000. So the price that I should pay for them today is more than they are worth. Thus, the negative net present value suggests that I should not do the investment. I'm asked to pay 6 lei for the kilo of apples when I was willing to pay only 5. For me, the price of 5 was fair. More than 5, I considered it from the beginning not fair, and I decided that I would not be willing to pay it. So a negative net present value suggests that we should not do the investment. Nevertheless, I have to come back to the residual value, as I have said. Again, this value tries to present itself as a quantification, an estimation at least, of the values of the future gains after year 5. There are different ways to estimate the residual value. The most common way is through capitalization. The capitalization is a simpler form of discounting. That is, they imagine, because again, this is the most popular way. I try not to use it. I don't like it. But this is the most popular way. They imagine that, well, the net operating cash flow from the last year, this one here, can be replicated in the future, year 6, 7, 8, for a reasonable amount of time, without saying what amount of time that is. Who knows, 10 years, 15 years, something like that. How much would someone pay for an infrastructure that would generate, in this case, 132,000 euros each year? Well, the same question comes back. How much would they expect as a yearly rate of return? Usually, the capitalization rate is considered to be equal to the discount rate. So let's say that it is so. How do I establish the value at the end of year 5? Through capitalization. The value of the yearly net operating cash flow over the capitalization rate, in this case 15%. It would mean, in this case, a lot, as you can see. It would be 880,000 euros. And if I were to consider it more or less correct, approximately correct, as you can see now, my net present value becomes positive, and I am encouraged to do the investment. Now, this method, as I was saying, is probably the most popular one all over the world. I try not to use it unless I'm being forced to do so. I mean, many times you are being forced to do so because you are preparing the feasibility study for someone else's decision. I may be doing the feasibility study for a bank. I want to get a loan from the bank, and the bank demands for a feasibility study. And in this case, they sometimes they do, sometimes they don't. Sometimes they do impose a specific methodology of doing this financial feasibility analysis. Or I may be doing the feasibility study for an agency that, well, I want to convince to give me subsidies for the investment. For sure, in this case, they will have their own methodology, and I have to respect it, to use it. So again, I may be forced to use the capitalization method. If I'm not being forced to use it, I'm not going to use it because, as you can hopefully see, it's quite optimistic. In this case, the estimation is that someone under market conditions would pay 880,000 euros at the end of year 5 for the investment that today new would be of 508,000 euros. So someone would pay more in 5 years. Now listen, the only important real reason for which normally someone would pay more would be if the value of the infrastructure would be increased by the market relationships that we would create, the flows that we would establish within the company and between the company and its partners. So basically what we are forecasting here in this case is that the value of the investment and of the company will increase, thus overlapping the cost of the investment components. Again, this is, however, an optimistic approach, especially for a startup. Maybe for a company that is already established, that already has a certain market, a certain market position, then maybe the risks are lower, the probability of its activity developing is higher. But for a startup, in my humble opinion, this is much too optimistic. So I would rather use a method that is not really accepted worldwide. It's more pessimistic. I would simply use as a residual value the net accounting value of the investment components. It's much more conservative. It does not take into account the increase of value for the investment because of the flows and the relationships created in time. Well, hopefully created in time, but not so sure. So in our case, to estimate the net accounting value of the investment components, I would need what? I need to go back to my depreciation chart, which should be somewhere around here. I have here the gross values of the investment components, not all of them, those that would involve depreciation. I have the yearly depreciation charges and I could insert some lines here to calculate the net accounting values. So I'm starting from the gross value of the investment components, and I am taking it from the investment budget, the 508,000. The cumulative depreciation equal to the depreciation charges for the first year, then for the following year, the depreciation charges from the first year plus the depreciation charges for the second year, and so on. And the net accounting value of the investment, the difference between the two. And at the end of the fifth year, it would be of 362,000. Now let's use this as a residual value. So again, this is a more pessimistic approach, but I would rather use this for a startup. I'm saying it again, in many cases, I may not be allowed to do so if someone else imposes its methodology to me. If I am allowed to use it, I am going to use it. So as you can see, at least in my case, the net present value is still negative in this approach, but quite close to zero. Now, I'm going to try to make it zero. Just give me 1 second. To do so, what I need to do is to increase the yearly net operating cash flows just a bit. To do that, I could simply increase a bit a price. I have many products, so I could just increase a price for one of them. Let's see. I'm going to the first one, whole potatoes, and I was planning to sell the kilo for 0.9 euros. So I could either increase the price a bit, or I could just increase the quantity being sold by a bit, or I could decrease the prices for the raw materials. I can do many things. Let's increase the price to 0.95. I don't think it's enough. Let's see. Still not enough. So let's say 1. It's a bit too much. Let's say 0.98. It's really zero. 89, 80, 89, it's really zero. So what does this mean? The net present value is really zero. Should I do the investment or not? What do you think? What does this suggest? That I should do the investment or not? Is it feasible from the financial point of view? Is it a good idea or not? Go ahead. Are you there?
Yeah.
So at this point, I got to a net present value of 0. It's 89, it's really 0, considering the value that we are talking about. 89 is nothing. What does this suggest? Should I do the investment or not? Because the net present value is an indicator that should help me decide whether to do the investment or not. That should tell me if the investment is financially feasible or not. What should be the net present value, the minimum level of the net present value for me to do the investment? What do you think? Think about it. If the net present value is 0, such as things are in my case, this means that what? The present value of all the future gains, so this value over here, so the price that I would be willing to pay for those future values is exactly equal to the value of the investment. So equal to what I am paying if I do the investment. That would mean that if you see the value of the investment as the price that we are paying, basically in this case, we would be paying exactly the fair price. We are paying 5 lei for 1 kilo of apples. We are paying 409,000 euros for future net operating cash flows that are worth to us in the present exactly 409,000 euros. So we are paying the fair price. What does that mean in the end? Does that mean that in the future we would only recover our capital and that's it? No, that's not it. This means that we would recover our capital and gain 15%. So the level of return that would satisfy us. So if the net present value is 0, we do the investment because that means that it allows us to recover our capital and gain a return equal to our discount rate. So basically the return that would satisfy us. So when the net present value is 0, we recover our capital and we get a return that's satisfying to us, that's sufficient to us. Nothing more, nothing less. Okay? So whenever the net present value is 0, this suggests to us that we do the investment. If the net present value is higher than 0, we do the investment even more. We are, encouraged to do the investment even more. because we get our capital back, we get the return of 15% that we expect, and some extra return, something in addition. But if the net present value is less than zero, is negative, that means that we, even if we might get our capital back, possibly, depends on how low the net present value goes. In any case, we will not obtain the desired rate of return. Okay? So this is how we use this indicator. If it's zero or more than zero, it suggests that we do the investment. If it's less than zero, we shouldn't do the investment based on it. So I'm going to mark it as 1, and I'm going to say net present value. And of course, it would be measured in the monetary units, in our case, in euros. Now, for a simpler way to calculate the net present value, just use the NPV function in Excel or in the Google Sheet. I'm going to create a different table to show you how you can do it. And I'm going to say NPV is the same thing, but it's just because I'm using the Excel and Google Sheet function. So I need the cumulated cash flows. Let's call them total cash flows or something like that. Net cash flows. So I'm going to say forecasted net operating cash flows plus residual value less the value of the investment. For the first 2 years, obviously, they will be negative because all we have are the investments, but they will become positive in the following years. I also need the discount rate, and I'm taking it from the first table. And now, to calculate the net present value, I use the NPV function, which basically does the same thing we did in the first table. So, net present value of the rate of return and the string of cash flows. As you can see, we get the same value. Okay. So, of course, you could use either of these two formats, but again, I'm expecting you to simply take this sheet and apply it to your own forecastings. So this way you will be using both of them. I'm going to stop for a moment to see if you have questions concerning the net present value before going to the internal rate of return. Are there any questions? So I'm guessing that most of you have already used this indicator or at least encountered it at other disciplines. Am I right? I probably am. It's not the first time that you hear about it. So at least because of that, I hope that you understand it better. Maybe I showed you a different approach than the one you were used to, but you probably understand it. Of course, you will also have the recording. You also have the cost-benefit analysis guide that I showed you before on the platform. And apart from that, I'm sure that if you do a search over the internet, you can find a simple definition. Let's see, net present value. The difference between the present value of cash inflows and the present value of cash outflows over a time period. That's the present value of the cash flows, not the net present value. NPV is used in capital budgeting and investment planning to analyze. Yeah, right. So it's a bit general. But again, you have, so this seems to be on, you have a detailed formula also in the material that I posted on the platform. This could be a good approach. Some of the investments benefit or cash inflows. Yes, this could be a good general approach. So my point is that you have a lot of information in the recording, in the materials, in maybe the materials that you have from other disciplines, and of course you can find online many definitions of the net present value. It's because it's a very, very common indicator, a very, very popular indicator all over the world. But I want to underline that for sure I'm going to ask you questions at the exam from this part. So as you know, I'm giving you a grade on one hand for your work during the semester, but at the exam, I'm going to give you a grade for the way you answer the theoretical questions, and all the theoretical questions will be from this part. I can tell you this. It's no, I don't want it to be a surprise. From this fifth, where is it here? Part, the financial feasibility analysis. So for sure, I'm going to ask each of you what the discount rate is, how it can be established, what's the definition or what does the residual value mean, what's the meaning of the net present value, how can you make a decision of investing based on it, what happens if it's negative, if it's zero, if it's positive. So for sure, I'm going to ask you that, obviously, to make sure that you have understood. So these are not necessarily complicated questions, but these are at the core of our discipline. This is the more technical part of our discipline. Because of course, we talked about forecasting, but the forecasting is not specific. You've done maybe forecasting at financial management. We talked about the market, but the market, you've talked about it, of course. You had at least one discipline in marketing. But this financial analysis part is at the core, from the technical point of view, is at the core of our discipline. So if you need to clarify things, you can do so now or later. Again, as I said before, we can meet. If you send me an email, we can have an additional meeting or two if you need them before the exam. But I'm interested in making sure that you have correctly understood this part.
And basically, just to clarify, the exam will be the presentation of the project and a few questions from your side.
Exactly right.
Okay,
Right.
perfect. Thank you.
You will be having, and we can establish this at the end of our meeting, or maybe even now. Maybe, let's say, maybe 8 minutes for the presentation, and we'll leave 2 minutes for my questions, more or less. And if we agree to that, my suggestion is for you to prepare your presentations based on this structure. So don't prepare a PowerPoint, or prepare a PowerPoint if it helps you. During the presentation, I will not look at your PowerPoint. I will be listening to you, and I will be looking in the feasibility study. So my suggestion to you is to prepare yourself to make a speech of 8 minutes in which you will be presenting the most important parts. The business idea, the most important elements of the operating cycle, then the investment budget, then the financing sources, then the market, identify the market in 2 or 3 words, then present the way you have performed the market analysis and the main conclusions, then the marketing strategy, the most important elements of it. For the financial planning, maybe the types of revenues and the most important types of charges, and then get to the financial feasibility analysis. Present the indicators, the net present value and the internal rate of return. That will be enough. We will focus on these 2. And explain the conclusions. Then go to the sensitivity analysis, which we will be discussing in a moment, and present the main conclusions. So try to go through these subjects in, let's say, 8 minutes. It should be enough. Again, you will not be talking a lot, maybe half a minute or a minute for each. After that, as I said, I will ask you probably some questions, who knows, 2, 3 questions from this part. So maybe a total of 10 minutes. Normally, if I see that the project is done in detail, that everything is well, that you know what you are saying, I will probably stop you earlier, because the whole point is for me to make sure that you know what you are doing, that you understood what you should have understood, and that you learned what you should have learned. And I will ask you additional questions if I'm not sure that you, or if I'm not sure of your level. So we'll see. Okay, can I pass to the internal rate of return?
Yeah.
So, okay. So, as you can see, the net present value gives us in absolute values some estimation of the gains, the extra gains that the investment could generate us. Because again, if the net present value is 0, that does not mean that we gain nothing. That means that we recover our capital and we gain a yearly 15%. So we gain exactly the amount that we consider to be enough for us to do the investment. So please don't forget that. A net present value of 0 doesn't mean that we gain nothing. It means that we gain exactly the amount that we consider to be enough, that satisfies us. I mean, enough to convince us to do the investment. If the net present value is of more than 0, that only means that we gain more than it would have been enough for us to do the investment. In absolute values, the internal rate of return more or less tries to show the same thing, meaning that it tries to show the financial performance of the investment, but in relative terms. So it would be an indicator that we would compare, and remember this because I'm going to ask you for sure, that we would compare to the discount rate, to the rate of return that we would be expecting. I'm going to create a third table.
I'm sorry, I missed for 20 minutes during this course. So, what exactly is the discount rate, just in a nutshell?
The discount rate is the rate of return that we are expecting from the investment.
Okay, so it's basically the profitability that we expect.
That we expect, but remember, this is different. Not the return, not the profitability. The profitability is different. The return that we expect, but in the sense that we would consider to be enough for us to do the investment.
Okay,
It's not the actual return of the investment. The actual return of the investment is this internal rate of return.
okay, okay.
That is exactly why we are comparing the two of them. In a moment, you will see it, I hope. So, internal rate of return. Again, we are comparing the value of the investment to the value of these future gains. But the equation is not really an equation. So there's not a mathematical formula to calculate it. In the past, people were estimating it, not calculating it, approximating it. How? Based on the following reality. The rate of return, the internal rate of return of the investment, when it is equal to the expected return, so the discount rate, the net present value becomes zero. So based on this reality, it was usually being estimated. Some 30 years ago, you were doing it on paper by drawing charts, simulating different discount rates that would make the net present value be zero. We are doing the same thing today. It's just that we are not using the pen and paper. We are using the IRR rate, function from the Excel sheet or the Google sheet, which at its turn does the same thing. Excel or the Google sheet does many computations, many simulations very quickly to determine the closest discount rate that would make the the net present value equal to zero, or I mean the closest to zero. So look, I need these total net cash flows with the residual value. There is no need for the discount rate here. And for the internal rate of return, for sure in this case it will be 15, because as you can see, a rate of 15 gets me to a net present value of almost zero. So I know that it is going to be 15 in my case here. So I'm using the internal rate of return function of the array of cash flows, and it's 15%. Now, listen. This is the, I underline it, the actual rate of return of the investment. This over here, the discount rate, is the expected rate of return. If I would be satisfied with, let's say, 12%, what would happen with my net present value? Would it change? If I'm lowering my, it would change, it would increase. Why would it increase? Because the present value of the future gains would increase. I would be willing to pay more for those future values if I am extracting from them only 12% return. Look, so at a discount rate of 12%, my net present value is of about 50,000 euros. Again, in this case, the internal rate of return, of course, remains 15%. This is the actual return of rate of return for the investment, 15%. So it's 12% is enough for me to convince me to do the investment, but I am getting 15%. Obviously, whenever the internal rate of return is higher than the discount rate or the expected return rate, I am encouraged to do the investment. Whenever the internal rate of return is higher than the discount rate, of course, the net present value will be higher than zero. When the internal rate of return will be equal to the discount rate, so the expected return, that means I'm getting exactly what I'm expecting, the net present value is zero. And I do the investment, again, because I'm getting what is enough for me, what satisfies me. If the internal rate of return is lower than the discount rate, so then the expected rate of return, the net present value is negative, and I'm not doing the investment. Look, if I'm using the internal rate, the exact internal rate of return, as a discount rate, the net present value should be zero, and of course it is. Okay? So if we agreed on keeping the discount rate at 15%, let me just increase my internal rate of return a bit by increasing a bit maybe my prices. So I got to a net present value of 126,000 and an internal rate of return of 23%. Now, listen. As a general idea, of course, you would want your internal rate of return to be 1,000%. But as you can imagine, that usually doesn't happen. If there were investments that were to generate 1,000% returns, internal rate of returns, logically, the capital from the capital market would migrate towards those investments. So there would be more investments of the same time, and the return would decrease. So logically speaking, the internal rate of returns over time are related and tend to not necessarily be equal, but tend to be closer to each other. So it would be highly unlikely to have an investment with internal rate of returns of 100, 200, 300%. It's possible, of course, and obviously you can name businesses that grew quickly and investments that generated insane internal rate of returns, but these are exceptions. My point is that when you finish your main scenario of forecasting, I hope that you will get to an internal rate of return close to mine, close to maybe 20%. If it's less than 50% and thus the net present value becomes negative, suggesting not to do the investment, try to correct the forecasting, try to see if you can increase the efficiency in the way you plan to manage the business so that you can get to a positive net present value. But if the internal rate of return is higher than maybe 30%, then you should start to think whether you are not too optimistic. So in theory, I don't have anything against you coming with an investment with a feasibility study in which your internal rate of return is of 80%. But if that will be the case, be sure that I will ask you to explain what is special about your investment. I mean, I'm expecting you to have analyzed this and to have solid arguments for that internal rate of return. So I want to make sure that it's not a mistake, that you didn't do the forecasting in a hurry and you were much too optimistic in your hypothesis, but that you considered it very well, and indeed you can argue that this investment is so special. So again, I'm expecting you with internal rate of returns of, I don't know, 16 to 25, 28%. If it's higher than that, okay, but I expect you to be able to explain what's special about your investment, so special. Okay. So having said that, my proposition is for you to stay with only these two financial indicators. I'm less interested in the profitability index, which is basically present value of the future gains over the present value of the investment. So it's a way of presenting the net present value in a relativistic manner. So it's not present value of the future gains minus the present value of the investment, but rather present value of the future gains over the present value of the investment. So when the profitability index is 1, the net present value is 0, and the internal rate of return is equal to the discount rate. When the net present value is higher than 0, the profitability index is higher than 1, and the internal rate of return is higher than discount rate, and the other way around, of course. So it's not a big deal. It's being used less than the first two indicators, which is why it's not that important to me. The cost benefit ratio, it only takes into account the payments throughout the operating activity and the inflows, cash inflows, and it calculates the present value of these future inflows and outflows, and does the one over the other, inflows over outflows. So it's even less relevant and less important and less used. And the payback period, it's an estimation of the number of years in which we can get our capital back. But I would rather stay with these first two indicators, the net present value and the internal rate of return. So let's focus on these two, which are the most common ones. They are used always, I would say, all over the world. So for the final part, let us say that indeed my investment promises this internal rate of return of 23%, and as my discount rate is of only 15%, so my expected return is of only that. Of course, I am being encouraged to do the investment. However, I have to understand that the value of this internal rate of return is based, and I have said this before, is based on these values, and of course, in particular, the values of these net operating cash flows. At their turn, these net operating cash flows, these ones over here, as of course you know, are based on all these tables. And of course, all these tables are based on all these green cells. And unfortunately, the green cells contain hypotheses concerning the values of different factors, factors that we cannot control entirely. What that means is that the risks that are involved with, well, the values of these factors, in the end, influence the value of the internal rate of return, and of course, also the net present value. So on one hand, in the main scenario, the value of the internal rate of return and at the same time the net present value suggest to us that we should do the investment. But we understand that all these green cells, and there are a lot of them, as you can see, I guess over 100 at least in my simulation, and it's not a very complex simulation. The risks that are related to these green cells basically affect the value of the internal rate of return. So yes, in the main scenario, the internal rate of return is of 23.05%, and it suggests that we should do the investment. But what if some of these risks occur? Then the internal rate of return could decrease, and it could drop under 15%. And our investment maybe would not be feasible anymore. You see? So we cannot stop with the analysis over here. We also have to take into consideration the risks that are involved by all these values, based upon which we calculated the indicators that encourage us to do the investment. So how do we analyze the risks? For sure, there are so many of them. We start by doing sensitivity analysis. What's that? We simulate variation of these green cells, of these factors, and we try to measure the impact of such a variation on our feasibility indicators, on the net present value or on the internal rate of return. And in this manner, we try to identify the factors to which we are most sensitive. I will show you. I will call this sheet feasibility analysis. And I will create a different one that I will call sensitivity. Let's choose some of the factors that we took into consideration when doing the forecasting. Some of the more relevant ones, maybe, is maybe the demand in the first year for each of the products. I'm not going to do a simulation for each of them because obviously this would take me many hours that I don't have. But I'm just going to take some examples. Maybe one for the price for the whole potatoes. I mean, yes, we planned to sell 1 kilo of whole potatoes for 1.1 euros. But is it really under our absolute control? What happens if the competition decreases the prices? We would probably be forced to decrease the prices ourselves. So let's see what happens then. I'm sorry, with our net present value. I will try to create a table format for you to use later on. And maybe I could put on one column the values from the main scenario. Values. So now the main scenario, I would mark it by 0. And the values from the simulated scenario. I can write it maybe somewhere. Values specific to the main scenario. And here we have those specific to the, let's say, simulated scenario. As a first factor, I will use the price for whole potatoes. Okay. We called it simply price. Price. In the main scenario, the basic scenario, it was of 1.1, and we could simulate a decrease to 1. Maybe here I could calculate the variation, absolute variation, and this could be the relative variation.
So in short terms, basically in the sensitivity analysis, we should aim to identify those factors who might impact our entire.
Indicators, performance, let's say performance,
Yeah.
performance that is viewed through our indicators, the net present value and the internal rate of return. Obviously, all of them will have an impact, but some more than others.
Should we
We are more sensitive to some than to others.
and in this analysis should we identify all the possible ones?
Uh, uh, Not all, because there would be, as you have seen, hundreds of them. Those that you would consider to be the most important ones, you will see immediately how to identify them in a first stage. Just give
Okay.
me 2 or
Thank
3
you.
minutes. So I'm calculating an absolute variation here, the values from the simulated scenario less the values from the main scenario. I'm simulating a negative variation, obviously, here. And the relative variation would be the delta, right? The absolute variation over the value from the initial scenario in percentages, of course. So in this case, I am simulating, as you can see, a reduction in the selling price of 9.09%. So this is the price. Now, on my second line, I think that I will want to have the net present value. So I'm taking the net present value from my feasibility analysis sheet, but be careful, I have to cut the links because later on I will do simulations and it will change there, you will see. So I'm copying it and I'm pasting it as value. Here, I'm leaving the link to the feasibility analysis. Okay. And now I'm going and changing the price here. I'm changing the price for the whole potatoes from 1.1 to 1. Now, obviously, this will decrease my net operating cash flows, and by doing so, it will in the end decrease the net present value, as you can see. From, in my case, 126,000 in my main scenario to 96,000 in this simulated scenario. So the sole cause of this reduction in the net present value of, as you can see in my case, about 30,000 euro is the reduction of the selling price for the whole potatoes. Now, the variation of the price was of, as you can see, negative 9.09%. And as a consequence, the variation of the net present value was of negative 23, almost 24%. So I'm going to calculate a sensitivity coefficient as the variation of the net present value, the result indicator, over the relative variation of the price. But usually it is not being showed in percentages, but in real values, in absolute values. 1 second. So I'm formatting it as a number, 2.61, not percent, 2.61. Now, I'm not interested in the sign of the coefficient. I'm interested in the absolute value of the coefficient, which is why I am going to use the absolute function In Excel, it's ABS. I hope that is the same in the Google Sheet. Yes. Yes, it works. Okay, it works. And we should also probably round it up to maybe 2 decimals. Let's use also the round function. Maybe at least 1. Okay, that should be right. So this coefficient characterizes the relationship, in this case, between the price for the wholesale whole potatoes, I'm sorry, and our net present value. The higher the coefficient is, the more sensitive that the net present value is to the variation of this price. And usually in practice, we use 3 sensitivity classes. I will say here on the last line, sensitivity class. And I will use the if function if the sensitivity coefficient is less than 4, let's say less or equal to 4, because in terms of practice, it's the same thing. If it's less or equal to 4, then say that the sensitivity is low. Let's say low sensitivity. Else, so if it's higher than 4, if nevertheless it is lower than 9 or equal at the most to 9, let it say that it's average sensitivity. And if not, so if it's more than 9, it should be indicated as high sensitivity. So of course, in our case, it's 2.6, which means based on this scale, low sensitivity. Let's see if we can also format it, conditional formatting. Based on the text. Let's see if this works. Or if it will see the text as the value of the cell, the value of the select text. Low sensitivity. So if it's low sensitivity, let's make it whatever. Low. Okay. Let's see if it works. It works. Okay. So, my suggestion to you is, once you did this, always don't forget, go back to where you did the forecasting to change the price to its initial value. But before doing so, you have to save these values, the value, well, the net present value over here. So for now, I'm going to copy the table to have maybe a sample with the formulas. So first I'm copying it. Now this value, I'm going to copy and paste it as value to break the link, the value of the net present value. Now I'm going back to the forecasting sheet and I'm changing the price back to 1.1 as it was in the main scenario. So everything is back as it was, but this table is not changed. Now for the second table, I'm simulating, of course, I can simulate the variations of the prices for each of the products, but I'm going to find something different. Maybe something from the charges, or in terms of the, I could be simulating, of course, also the value of the level of the demand. But if I stop at the raw material charges, I could simulate maybe a variation in the specific consumption or in the price of the raw materials. Let's simulate a variation of the specific consumption. Also for the whole potatoes. In the main scenario, the value was of 1.25. And we are going to simulate an increase. We have problems when the value of the specific consumption increases. Maybe I should change this to be more simple. I will say here factor to be representative for all the factors. So the value in the main scenario 1.25, I'm simulating an increase to 1 point, maybe it could be 26, it could be 30, let's say 30, to have a more even number. So this is a variation of 4%, as you can see. The net present value from the main scenario is this. Link to the table with the net present value. Now I'm simulating the increase to 1.30. And the net present value decreases a bit, as you can see, by 3.61%. So again, the specific consumption increases by 4%, but as a consequence, the net present value only decreases by 3.61%. So the sensitivity coefficient is of less than 1. So we are talking about low sensitivity on the scale that I gave you. Now, I can copy the value, maybe not to complicate things even more, I'm sorry. And then go back and change the value of the specific consumption to 1.25, I believe it was. Now for the price in raw materials. Or do I have a more interesting one? So of course you have a bit more time, you can do this simulation for 20, 30 factors. It would not be hard, as you can see. But the lower the value of the charges or of the revenues in the main scenario is, the lower the impact of their variation on the net present value will normally be. So first and foremost, try to simulate the variations of the revenues and the charges that are higher in value compared to the others. So let's do one more. Maybe the price for purchasing the potatoes, because it affects all the products, or at least 5 different products. Purchasing price for potatoes. It's 0.3 in the main scenario. And we will simulate it increasing to, let's say, 0.35. So as you can see, we can simulate an increase to 0.41, 42, 43. It's not really the same, but it's of less importance because the coefficient, we are calculating it in relative terms, variation of the net present value over the variation of the factor. So the coefficient could be different for different intervals of variation, but not by that much. So it's less important by how much you vary the factor. So you can round it a bit. Okay, so I'm simulating an increase to 35. I must not forget to come back to the... 1 second. Okay, I'm back in the main scenario here. I'm creating the link to the net present value. And now I change the price. I set to 0.35. And the net present value decreases by 41%, but still the sensitivity coefficient is 2.5, less than 4, so it shows low sensitivity. Don't forget to always go back to the initial value. So I imagine that these examples should be enough. Now, the point of this is to simulate variations for maybe 10, 20 more important factors. You can identify them more or less from the beginning. And then for the factors to which you show high or at least average sensitivity, in the last part of the feasibility study, you could make some comments. You could identify the maybe 2 or 3 most important factors and maybe explain a bit their relationship to the performance of the company, the conditions under which they might change their values. Are there any signs that could make you become aware of the changes that will occur? Is there anything that you can do to reduce the risk? And in the end, what are the measures that you could implement to counteract the occurrence of the risk? So this is it. This should be the last part of the feasibility study. Now, ask away if you have questions. I'm going to upload, of course, the recording. Now you have this spring break. My suggestion is for you to try to finish everything. And whenever you want, during the break, after the break, I'm in Timișoara, normally I'm working, so it doesn't really matter to me that much. Talk among yourselves, decide if you need to have another meeting. As I said, even more than one if you wish. And let me know. Send me an email and we can meet again once you have more or less everything, and you can ask me specific questions. Apart from this project, of course, don't forget about the internship. Hopefully you are doing well. Hopefully you started it, and on the other hand, that project is not that complex. Maybe you can even finish it pretty quickly. Don't forget that you have access to my Google Sheet, the one that we created right now. So take from it all the tables that you can use. I will upload at least one other example. You have the guide there on the platform if you feel that you need to consult it. And again, at least for these two indicators, which are very, very popular, you can find the information easily on the internet if the information that I give you should not be enough. So do you have questions for the time being?
About the project, do we need to upload it somewhere?
Yes, of course, of course. I will create a section on the platform exactly for this reason, for you to upload it. Of course, I do not know, same as you, we don't know when exactly the exam is going to be, but in any case, it will probably be in the first half of June. At least I'm expecting it, because the semester ends the 24th, I think the 24th of May is the last day of the semester. So the session, the exams start on the 25th. Most probably your exam will be, as I was saying, in the first part of June. So when the moment I will know the exact date, I will create a section there on the platform, and you will be able to upload the project until the day of the exam. At the exam, as I told you, for the exam, please prepare a presentation of 8 minutes. Again, I mean a presentation in the sense that prepare yourself to present the most important parts of your project in 8 minutes. I don't mean prepare a PowerPoint or anything else. I'm not going to look at it. I'm going to look in the feasibility study when you are going to present. And of course, I'm going to analyze the feasibility study in detail afterwards, and I will give you the grade. Any other questions? with the other project for the internship? Is it all clear?
Not really for me, it's not clear. No.
Okay, let's see. You have 3 possible subjects. Have you chosen one of them? Either marketing, either financial statement analysis, or investment analysis?
No, I haven't. No.
So go on the platform, you will find the 3 possible subjects. For each of them, you will find the structure. Choose one of them. Let's say that you choose financial statement analysis. There, the point would be for you to perform a financial statement analysis on a company, but on a company that you have access to. So I don't want to see an analysis done over a company from the stock market for which you found financial statements over the internet. I'm not interested in that because your analysis will be too theoretical. The whole point of this is for you to have access to information from within the company to be able to correlate the values of the ratios to specific phenomena that you identify in the company.
Yeah,
So,
that's
yes, please.
actually my problem because I don't have access to data of the company I work with.
Well, choose then another subject. Choose the subject with the market and do analysis on the market of the company and propose a simple market strategy for the company based on the analysis. Or find another company from which you can get the financial statements and to which you can ask some questions. Do you think that you can manage that?
I'll manage something, yeah.
Okay. So again, please don't hesitate to contact me. I have no problem meeting with you again and discuss the projects. Just decide when you want it to be and let me know. I guess sometime in the evening, like we did so far. But my suggestion would be for you to continue with the projects now during the break and maybe meet with me before the end of the break. If you can finish the projects or at least get to the final stage with them, we can meet before the end of the break. I can answer your questions, help you finish the projects, and then you know that in the second part of the semester, the last part of the semester, you can deal with the other disciplines. So anyway, this will be up to you. Just let me know if and when you want to meet again. For now, I guess this is it. I thank you for all your participation in the classes, and I hope to see you again real soon. So have a, I don't know, nice and quiet holiday.
Thank you. Same
Thank
to
you,
you.
you too.
Bye.
Thank you. Bye.
Bye.